bank reconciliation statement. It is actually an extension of the cash book. These are only the petty cash book. When we talk about the 2-column cash book, the 3-column cash book, then at the end of the day, we need to compare the balance of the bank column with the balance in the bank statement. So bank reconciliation statement simply entails trying to find out why the cash book bank column balance and the bank statement balance may differ. In most cases, when the accountant has prepared the cash book in the business, remember the cash book has got the following format. We have got the date, the details that are talk about the 2-column cash and bank. On the other side, we have got the date, the details, cash and bank. That is your cash book. Cash and bank. Our interest is only in the bank columns. This bank column here, this one here. This bank payment on this side, it is used to record any payment that we made in the form of a check. And here, it is going to record any receipt in the form of a check. Any check that we receive, we record it here. Any check that we issue out or we pay with, it is recorded here in the cash book. At the end of the month, probably, we normally balance our cash book, and therefore we shall record somewhere the balance carried down, which is normally the difference between the receipts and the payment. The total amount received minus the total amount paid here gives you the bank balance. Then the other thing happens. Anytime you issue a check, that particular person must take that check to the bank so that money can be transferred from your account to his or her account. Anytime we receive a check on this side, we must take that check to the bank so that money can be transferred from the account of the customer to our business bank account. So we are going to be dealing with the 2 documents here. At the end of the day, the bank will be preparing a bank statement, or a bank statement will be generated. And here we have prepared a cash book. All the checks that we have received, we have taken them to the bank so they should reflect in our bank statement. All the checks that we have paid, they have been taken by our creditors or suppliers to the bank, so money has been transferred from our account, so that particular transaction is in the bank statement as well. So ideally, if all the checks that we receive and all the checks that we pay have been taken to the bank, and therefore the balance that we have calculated here should be the same as the balance in the bank statement. If we go and request for the bank statement for the same period, maybe this is the cash book for January 2023, we go there, we request for the bank statement for the month of January 2023. Ideally, those balances should be the same, because anything that appears in the bank columns of the cash book should appear in our bank statement. But in most cases, those 2 balances don't agree. Either the cash book balance is more than the bank statement balance, or vice versa. The moment they don't agree, then the accountant has got a responsibility of doing or preparing what we call the bank reconciliation statement. A reconciliation statement is a statement that tries to explain why the cash book bank column, remember we are not interested with the cash, we are only interested with the bank, because we are talking bank record in the business, which is the cash book, and bank record in the bank. So we are comparing bank, not bank and cash. So if they are supposed to be the same, and yet we have confirmed they are not the same, then we need to find out why they are not the same, because they are supposed to be the same. So a bank reconciliation statement is a statement that explains why the cash book bank column balance differs with the bank statement balance, for the same period of time, for the same period of time. So that is what we are going to look at. Before we go far, I've given you or I've reminded you of the format of the cash book. Then we need now to look at the format of the bank statement. The bank statement will show the following format. So it will have the column for the date, the details, the debit, the credit, and then the balance. That is the bank statement format. Like that. I don't know whether it was in this class or it was the old curriculum class. They asked me a question: why, Mwalimu, are you saying that we have received the check and we record it on the debit, whereas we know when the check is received, we normally hear that it is credited in the bank, which is true. Which is true. We normally hear that your account has been credited. That is when money is coming into your account or it is deposited in your account, which is true. In the cash book, when we receive money, we debit. We normally record it on this side, we call the BR. But when we pay, we record it on this side where we call the CR. This means payment in the cash book, but the opposite happens in the bank. In the bank, anytime money is deposited into your account, it is going to be on the credit side. So like for example, here, let us have a simple illustration. Here, maybe you have received this is 1st of January. You have received a check from John of 1,000. You put it under the bank. It is going to appear on the debit side in the cash book, but when you come here, it happens to have been deposited the same day, 1st of January, we shall write here the John, it is going to appear on the credit side. So on the cash book, it is appearing on the DR side. But the bank statement is going to appear here. If we pay a supplier, like for example, on the date, 3rd of January, we have paid ABC Limited, maybe 500 by check. What will happen here, we shall come and find it here, 3rd of January, ABC Limited, it is going to appear here as 500. So a debit in the cash book, it is going to be reflected in the credit of the bank statement. Or in simple terms, receipt in cash book is debited, but receipt in the bank statement they are credited. Payment in the cash book they are credited, but payment in the bank statement they are debited. So they go on the opposite way. They go in the opposite way. So you need to understand that. So at the end of the day, the balance that we get here, the balance that is going to appear as the last figure here in the bank statement should actually be the same as the balance carried down that we have computed in the cash book, if everything was okay. But the moment the figure that is appearing last here, it is not the same as this one, then there is a responsibility to the accountants to do a bank reconciliation statement. That is a brief introduction of that area. After doing so, now we need now to ask ourselves, why or what makes the cash book bank column balance differ with the bank statement balance? What are some of the reasons that can make the cash book bank column balance to differ with the bank statement balance? We have got two broad reasons. Number one, some items will appear in the cash book but miss in the bank statement. So one, we have items appearing in the cash book, but don't appear in the bank statement. They are appearing in the cash book, but don't appear in the bank statement. That simply means that those items are recorded in the cash book. But when you try to find them in the bank statement, they are not there. And those items, they are grouped into three. Actually, there are three in number. A is what we call unpresented. Unpresented checks. B is what we call uncredited checks. C is what we call cash book errors. The cash book errors. Those are the three items that will appear in the cash book, but when you try to find them in the bank statement, you don't see them. The unpresented checks are the checks that we have paid our suppliers, but those suppliers have not presented them for payment in the bank. I give you a check this month, but you don't present it for payment this month. You present it maybe later next month. So when I will be going to the bank statement to request my bank statement, when I go to the bank to request for the bank statement, that check that I paid you will not be there simply because you have not presented it for payment. So when I issued that check to you, I, as the accountant, I recorded it down as a payment. So it is appearing in my cash book as paid. But in the bank statement, that money has not been paid. So my bank balance is more in the bank. I've given you a check of 10,000. In my cash book, I have written it down or I've recorded it down as an amount paid. So it is appearing on the credit side of the cash book, which is a minus. But in the bank statement, that money has not been deducted from my account because you have not presented the check. So that is going to appear as an unpresented check. An unpresented check. So note this, unpresented checks are those checks that have been paid to suppliers or other creditors, but the suppliers or those creditors have not presented those checks for payment. So those are checks. When you look at the payment side of the cash book, you can find them. But when you look at the debit column of the bank statement, because we have said a credit in the cash book corresponds with a debit in the bank statement. So when you find or you look at the credit of your cash book, you can find that I paid a money wholesalers 10,000. But when you go now to the debit column of your bank statement, that 10,000 has not been debited there. So automatically that becomes an unpresented. Number two is what we refer as the uncredited checks. Remember we said, to credit in the bank statement simply means money in. Money has been received in your account. So uncredited checks is those checks or they are those checks that we have received, but the bank has not cleared them for money to reflect in our account. Either we have not also presented them for payment from our end, or we have presented them, but they have not been cleared, especially when we take those checks the last day of the month. We know a check can take 1 or 2 days before it is cleared by the bank. So if I take the check on the 30th of January, that is a check that I have deposited. Probably it is a check from another bank. It might take 2 days before money reflects in my account. So if I deposit the last day of the month, probably if I request the bank statement for that month, that check will not reflect or will not be there because it is going to be not yet cleared, so it is not yet credited. So when I look at my bank statement on the credit column, those checks will not be appearing there. And because they are not appearing on the credit side or the credit column of the bank statement, they are referred as uncredited checks. But remember, in the passbook, they have already been received. I receive a check from Ivan. I record it as received in the passbook. I take it to the bank. The bank has not cleared that check for that to reflect in my account. That check is an uncredited check. So any check that has not been cleared by the bank, or us as the business owners, we have not taken it to the bank so that money can be credited in our account, they will be considered as uncredited checks. Number 3, the cash book errors. A cash book is made by a human being. In the process of preparing the cash book, you can make an error. A check that you received, you can make an error and you record it as a payment. You can receive a check over 50,000, you make a mistake, you record it as a 5,000. And such kind of issues. You record either on the opposite side, instead of receipt, you put it on the payment, instead of payment, you put it on the receipt, instead of a correct amount, you use the wrong amount. Those are known as the cash book errors. Once they occur, obviously, the cash book and the bank statement balances will differ. Even this uncredited and presented check. If an item is recorded on the cash book, but it is not recorded in the bank statement, you cannot expect the two statements to have the same balance. That is the first category, items appearing in the cash book, but missing in the bank statement. Number 2, items appearing in bank statement, but miss in cash. Items appearing in the bank statement, but miss in the cash book. Meaning, the transactions that have occurred in our bank account, but we are not aware of. The business accountant is not aware that they have actually occurred in the bank. So these are transactions like A, when we have a deduction in form of bank charges. The bank can levy a certain amount as bank charges for transactions that we have that have happened in our account. So these bank charges, money has been deducted in our bank account, but in the cash book that has not been affected. Remember, in the cash book, when we deduct money, we credit, we record it as a payment. It is not recorded in the cash book as a payment, but already money has been deducted from our bank account. Number 2, it is the standing order. Standing orders. This is a request or instruction the account holder gives the bank to be deducting a certain constant amount, probably monthly, and then that amount be transferred to another or a different account. That amount must be constant. It cannot be something that keeps on fluctuating. It must be a constant amount, and it is payable within a constant interval, especially when you have something like insurance, savings, or something like that. If you are paying those premiums, you can issue a standing order. Each month, you'll be deducting 5,000 from my account, and that money is transferred to the insurance account. That is a standing order. When these standing orders are being honored by the bank, the accountant may not have also honored them. So if it has been deducted in the bank, the accountant is also supposed to deduct in the cash book and record it as a payment. If you find that it might not be the case. Then see, we have the dividends. Dividends received. If the business has got some investment in form of shares in other companies, when those dividends are paid into a bank account, money will be received in a bank account without our knowledge. So it is a receipt in the bank, but not recorded as a receipt in the cash book. B, we have got direct deposit. I owe you certain amount of money. I have your bank details, that is your bank account number and also your account name. So what I do, I just go and deposit that money in your account without telling you that I've paid you. So when you request the bank statement, that is when you see that, oh, Macaulay has paid me. So when a customer directly deposits money into your account without your knowledge, it becomes a direct deposit. We have others like the dishonest check. Dishonest checks. Dishonest checks, these are the checks you received, but when we took them to the bank has rejected them. The bank has returned them back. So in the bank, they have been dishonored, but in the cash book, they are there. So what do? We need to go back to our cash book and cancel them. We normally now cancel them from the cash book. A dishonored check is a check that has not been honored. Either the customer gave us a check which has a more amount than what he or she has in the bank account. Maybe the check is not readable. Maybe the check is stale, among other reasons. Regardless of the reason, if the check has been dishonored by the bank, then we need to cancel it out from the cash book. How do we cancel it? It was received, meaning that it was on the debit side. Now that it has been dishonored, we credit in the cash book so that we can cancel the initial deposit. So that we can cancel the initial deposit. Then we have things like the commission charge. The commission charge, among other things. And lastly, the bank statement error. The bank statement errors. Also, the bank statement or the bank staff can make errors. In the process of debiting and crediting your account, they can make some errors. Either they deduct more, they deduct less, they credit more, they credit less. They might occur, though very rare, but they are still human beings, they can make errors. So having understood that we have got these categories, items appearing in the cash book, not in the bank statement, items appearing in the bank statement, not in the cash book. And then you remember that the cash book bank column and the bank statement balance, they are supposed to be the same. And then you are required to do a reconciliation. How do you go about it? A bank reconciliation statement, or when this question comes in your exam, you will be asked 2 questions. Joseph, you can't hear? I'm not audible? Or now it's okay? Maybe it was a frustration.
You are very okay. I think Joseph has an issue with his internet.
Yes, it can either be a problem with my internet or his internet. Okay, if you can hear me well and good. This question, when it is tested in an exam, you will be required to do 2 things. 1, you prepare updated cash book, or what we call adjusted cash book. That is 1. 2, you prepare now the bank reconciliation statement. Those are the 2 questions that will be asked. A, or Roman 1, updated cash book. Roman 2, the bank reconciliation statement. Then you need to come here and consider this. This item, excluding G, excluding bank statement errors. These are items that are missing in the cash book. And they are missing in the cash book simply because the accountant was not aware that they occurred. Now that the bank statement is here with us and we have known that they occurred, these items now, we record them in our cash book. We record them in cash book because they were not there, simply because the accountant was not aware that they occurred. So now that we know that they occurred, the cash book they must be included. In the cash book, they must be included. So items appearing in the bank statement but missing in the cash book, apart from bank statement errors, they are used in updating them. They are used in updating the cash book, and then also this one. How do you update the cash book? You update by adjusting the errors. If there is a cash book error that occurs, you need to correct that with the updated cash book. And then you include these items that are missing in the cash book because they were supposed to be there. Because they are supposed to be there. Errors in the cash book and these items appearing in the bank statement but don't appear in the bank statement. And then these two plus this, then this one goes here. The unpresented checks, uncredited checks, and the bank statement errors, they are used now in preparing the bank reconciliation statement. Get me right? The bank reconciliation statement is normally prepared using these two unpresented and credited checks and then the bank statement errors. They are used in preparing the bank reconciliation statement. Why don't we use the unpresented and uncredited checks in preparing the updated cash book? The reason is they are already in the cash book. They are appearing in the cash book. We cannot put them again. They are already in the cash book. They are only missing the bank statement. So how can we put the unpresented and the uncredited checks in the updated cash book? Yes, they are already appearing there. So we don't use them because they simply appear. They were there from the word book. So they are only missing in the bank statement. Then these bank statement errors, these are errors that are not related with the cash book. If they are not related with the cash book, then we cannot make a mistake of using them in updating the cash book because from the word go, they are not related in the cash book. So in adjusting the cash book, we use this because they are supposed to be there, and then we correct these errors with that particular updated cash book. Then these ones, because they are missing in the bank statement, and this is an error in the bank, we use them in doing the bank reconciliation statement. So in a nutshell, this is how they should appear. Updated. Updated. Updated cash book. You will start with the balance of the cash book that will be given in the question. It can either be a debit balance or sometimes they can tell you it is an overdraft. You put it there like that. So it can either be this. You not have both of them. It must be one of them. Either you are told it is a debit balance or a credit balance. When the question does not specify whether it's a debit or a credit, take it to be a debit. But when you are told it had an overdraft, then it must automatically mean it's a credit balance. So updated cash book is a simple T account. Then here, this records the payment. This records the receipt. So what you are going to do from this list of items, anything that is a payment, you put it here. Anything that is a receipt, you put it here. So you are going to have like bank charges. It is money out of our account, so it is a payment. Put it there. Standing order is also a payment from our account. Put it there. Even the commission charge, you put it there. Put it there. And also the dishonored check. Put them there. Dishonored check is appearing there because we said that check was initially received. Initially, it was under the receipt, but the bank has rejected it. So what do? we cancel it by crediting the cash book. So that now, if we had debited 10,000, we credit here 10,000, it has cancelled out. The effect has been cancelled out. That is it. Those are the payments. Then, anything that simply means that money came into our account, but we did not receive in the cash book, we record it on the debit. Here we have direct deposit. Dividends. Those are amounts that were received in the bank account without the knowledge of the accountant. So they were not received, so we received them there. Then we shall calculate the new cash book balance. Remember the balance that we have indicated here for the cash book, it was the initial balance before these items had been incorporated. So these items were not used to arrive at that balance. Now we incorporate these items that happened without the knowledge of the accountant so that we can get the correct account balance. We can get the correct cash book balance. And then here we can also have the correction of the errors that occurred in the cash book. Like for example, the cash book errors. This is like understated receipt, where hapo, ama overstated payment. Understated receipt, ama overstated payment. Understated receipt, this is the receipt side. Understated receipt. It simply means that maybe we were supposed to record 10,000, but we recorded on the receipt side as 1,000. We omitted 1 0. Instead of 10,000, we recorded 1,000 as the receipt. We're able to be understated by 9,000. So you must record there understated receipt of 9,000 because we received only 1,000 instead of 10,000. So we do a top up. We add 9,000 so that we can get the correct receipt amount. Overstated payment here. It was a payment that was made, but we exaggerated the figure. Instead of 1,000, we recorded 10,000. We added a 0. So because here we recorded 10,000 instead of 1,000, then we overstated the payment. So the payment side is exaggerated by 9,000. So we shall come here and minus. Because 10,000 is there, instead of 1,000, 10,000 if it is there, we put here 9,000. So in simple terms, 10,000, then we cancel 9,000, we shall remain with 1,000 on the other side of a stated payment. Then the opposite will happen here. Understated payment. And then here we shall have overstated receipt. Understated payment. If it was a payment that was supposed to be of how much? 10,000. We wrote 1,000. That payment was understated by 9,000. Instead of 10,000, we wrote 1,000. So we put the difference 9,000 here. So that the 1,000 that we initially indicated there, plus the understated 9,000, it makes it 10,000, which is the correct amount. Overstated receipt means that we had received more. We received 10,000 instead of 1,000. So we had initially recorded 10,000 instead of 1,000 on the receipt. What will happen? The receipt has got 9,000 extra. So that 9,000 extra, which is overstated, receipt will appear there. So note this in accounting. If a figure is debited and you want to cancel it out, you put it now on the credit. If a figure was credited, you want to cancel out or to minus, you put it on the debit. You take it to the opposite side. That's why you are finding that when it is overstated payment, remember they are on credit. But now overstated payment become on the debit because we are trying to minus what was extra on the payment. When we talk about overstated receipt, it is on the credit. Yet the receipts are what? Debited. Meaning that the receipt side was exaggerated. So we are putting it here to minus the exaggerated receipt amount, like that. That is what you need to have it at the back of your mind. In accounting, when you want to minus or to cancel a figure, you take it to the opposite side of the same account. That's why even the dishonest checks are appearing here, because those are the checks that initially we received them, but the bank has rejected them. So what do? We also remove them, cancel them from our cash book, but we cannot take a ruler and cancel them. What we do, we record them on the opposite side. They were initially debited as receipt. Now we put them credit as payment. The effect will cancel out. Right. Having gone up to that point, I think the remaining part is also for you to understand how is the bank statement prepared. We have got two formats in which you are supposed to choose any one of them. So at the end of the day, here you get the balance carried down. Either there or here. The balancing figure. So that your cash book can balance. Once it has balanced, then now you can go ahead and prepare the balance. Reconciliation. We have got two formats. Format one, you can start with the balance as per bank statement. That figure will be provided in the question. If you start with that, then you add uncredited checks. That's why we say uncredited and unpresented checks will be used here. They will never appear here. We add uncredited checks, and then if there is any error that occurred in the bank statement and it reduced our bank balance, you add it here. Error that reduce bank balance. If any, this one is there. It will not be there in most cases, but if it is there, put there so that you can get out of there. Then you rest. The unpresented checks. Then if there is any error that increases your bank balance, you left it. There's error that increase bank balance, but if any, you minus, so that you can arrive at a figure there, which is supposed to be the same as this or this. Balance as per the updated card book. That becomes your bank reconciliation statement. That is format one. You can use the other format too. It is just the opposite of this. Instead of starting with this, we start with this group. We start with what we are writing, then we come here. So for format two, bank reconciliation statement. In format two, we start now with balance as per updated card. If you start with the balance as per the updated cash book, you add what you had subtracted. You add this two. Add and presented. Add and presented text. You also add errors that increase bank balance, if any. If any. You get a figure there. Then you rest. And credit and text. Also rest. Error that reduce bank balance, if any. So this minus this, it gives you a figure there, which should be the same as the balance. Balance as per the bank statement. So this is format 2. That is the format 2. The balance as per the bank statement will be given in the question. So you just compare the answer you get here with the figure that's given in the question, whether they are the same. If they are the same, reconciliation has taken place. If they are not the same, then either the question is not okay or the procedure, you have not done it right. The balance as per the updated cash book, it is this balance you arrive at after doing the updating of the cash book. This balance carried down is what we refer as the balance after the updated cash book. And once you have done that, you are sorted. Once you have done that, you are sorted. So basically that is it. So in our Sunday class, we shall...
Mwalimu, could you kindly project the board so that you could capture something? Thank you.